Good afternoon, ladies and gentlemen. I'm Eugene from SIAS. Thank you for joining us at Corporate Connect this afternoon. This webinar is organized by SIAS and supported by SGX. Today, we have with us Mr. Geoff Howie, market strategist from SGX, to share with us on market updates, followed by a presentation from representatives of the Straits Trading Company Limited, Mr. Eric Tang, Chief Executive Officer, Dr. Alan Tan, Head Portfolio Management, Mr. James Kwee, Portfolio Manager, Portfolio Management, Ms. Selina Ho, Head of Investors Relations. And we will end off with a Q&A session moderated by Mr. Benjamin Goh, Head of Research and Investor Educations from SIAS. Without further ado, let us welcome our first speaker, Mr. Geoff Howie from SGX. Over to you, Geoff.
Thanks very much, Eugene, and thank you very much for again having us with your session today. Really excited to be here, obviously with Straits Trading, and very much looking forward to hearing from Alan, Eric, James, and Selina. My name is Geoff Howie. I'm the market strategist at SGX, and we'll spend the next 20 minutes or so just running through the current market drivers of the Singapore market. So I must point out, of course, this presentation is designed to be purely informative, and recent observations will be predominantly on the moves in our Singapore stock market, and in no way are we providing any investment advice. So for the year to date, so far, we've seen our Singapore benchmark, the Straits Times Index, commonly referred to as the STI, generate an 8% price gain, with reinvested dividends boosting that total return to 11%. This takes the 10-year annualized total return of the STI to around 5%. And I guess of all the regional and the global indices, the STI is most correlated to our FTSE ASEAN All-Share Index. That's represented by the green line on the top right. This, I guess, built on very solid economic foundations, in addition to the regional bundling that comes with institutional portfolio flows, the STI and the FTSE ASEAN All-Share Index do share a pretty high simple correlation of around 93% in daily close prices over the last 3 years. Singapore stocks also make up around 27% of the weightage of the FTSE ASEAN All-Share Index, reinforcing that correlation. And the regional index maintains a market value of around $2 trillion US, very similar to the combined ASEAN GDP. I guess over the past 10 years, our GDP on a current price basis has averaged close to 4% annualized gains. Our Singapore government bond index at the same time generated around 2.2% annualized returns, and the Urban Redevelopment Authority Property Price Index by residential type generated a annualized gains of 1.1% on the back of the ongoing prudential cooling measures to the local housing market, which have been in effect since 2011. For trading opportunities, I guess within and beyond the STI benchmark, of the current 30 STI stocks that all have a 10-year trading history, Mapletree Industrial Trust, Venture Corp, and Mapletree Logistics Trust all outpaced the Dow Jones, all outpaced the STI with 16% annualized total returns, while the least performing stock of the STI over that 10 years was Dairy Farm International with a 6% annualized decline in total return. I guess more recently, there are the 7 REITs that make up 14% of the STI weightage, and the 3 banks at the same time make up a little over 40% of the STI. They have been very much impacted by global sector trends this year, providing rotation opportunities. For instance, banks were the strongest sector of the first quarter of this year on the back of resilient investment activity across the globe and a generally steeper yield curve, which is shown in the lower left chart. The lower left chart by the dotted blue line. And that has supported banks that obviously borrow short and lend long. But what's interesting is since the 8th of June, when the 10-year yields ended that New York session at fresh 12-week lows, the US yield curve has flattened from close to 140 basis points to 110 basis points at present. And that flatter yield curve on the back of lower 10-year yields has coincided with a rotation into global REITs, which maintain a median yield of around 4%. And this has seen REITs outpace the banks since the 8th of June through to right now, the present. Global banks indices, they're down 6% since the 8th of June, while global REITs are up 1%. And this is extended to the STI, if you will, with the 7 REITs averaging 3% total returns since the 8th of June, while the 3 banks, DBS, OCBC and UOB, have averaged a 2% decline in price. Now, the big moves of 2020 and 2021 also attracted a surge of retail investor flows in the market, which, as illustrated in that lower left chart, they do tend to swing to net retail inflows amid market weakness and swing to net retail outflows amid market gains. For instance, Singapore's largest stock by market value, in addition to our most traded stock, DBS Group Holdings, saw close to 2 billion Sing dollars in net retail inflows for the first 3 quarters of 2020. The volume weighted average price for the stock over those 3 quarters was $21.01. Then DBS Holdings saw net retail outflows of 1.9 billion Sing dollars in the subsequent 3 quarters, from the 4th quarter of last year through to the 2nd quarter of this year, with a 9-month volume weighted average price this time of $26.42. So that VWAP price amidst the 3 quarters of the significant amount of retail selling, net retail selling, was 26% higher than the 3 quarters of the significant net retail buying. Hence, while the STI, I guess, provided those modest 5% returns over the past 10 years, comparable to the growth of other asset classes and the regional index, retail investors could have had the opportunity to take those opportunities amid the week-to-week developments in economic growth, our global efforts in containing COVID, and the resulting sector trends and the big moves. And this was, I guess, further demonstrated with close to 60%, that's 60% of the combined inflows of the 2 STI ETFs over the past 10 years coming in the space of just 10 months. In that 10 months that spanned March to December last year, when the VWAP of the 2 STI ETFs was around $2.65 to $2.70, the ETFs have since moved up to above $3, currently trading at around $3.10 per unit. Now, this is a big driver of the STI, the competitive edge of global banks, because as we said, the banks make up more than 40% of the STI. So far this year, the 3 banks have averaged around 20% total returns, which has been very closely in line with global banks, which are also generated around 20% returns. For the 2nd quarter ending June, the trio of DBS, OCBC and UOB reported combined net interest income of 5.13 billion Sing dollars. That was up 1% from the 1st quarter of this year. And for the trio, this was the highest quarter-on-quarter increase to net interest income since the 3rd quarter of 2019. The growth drivers for the trio, they include increased digitalization, the broadening of wealth management services, and a continued focus on the supply chains of growth markets. For growth markets, DBS, OCBC and UOB have increased their combined annual income that is segmented to Greater China from around 2 billion in 2010 to more than 5 billion in 2020. UOB's rest of Southeast Asia franchise also grew 7% against last year on the back of strong growth in Indonesia and Malaysia. And DBS has also highlighted this year that the amalgamation of the LVB in India business and its joint venture in the securities business in China will enhance its presence in both key markets. As illustrated in the lower left chart, combined wealth management net fee and commission combined net fee and commission income for DBS, OCBC and UOB has almost tripled from a near 700 million in the first half of 2014 to close to $2 billion in the first half of this year. Now, within the bank sector, DBS and OCBC have more net revenue, report more net revenue to Greater China, and also maintain more loan exposure to mainland China than UOB. And this has coincided with some potentially measured, albeit marginal moves this month. Back on the 14th to the 15th of September, we saw UOB add 0.1%, while DBS declined 0.7%, and OCBC declined 0.3%. as China Evergrande declined around 17% over that period, and the H-share index declined 3%. And at the same time, we saw monthly China retail sales and industrial production prints come in below expectations. Now, similar moves were observed again for the first two sessions of this week. We saw UOB decline 0.4%, 0.4%, compared to DBS declining 2% and OCBC declining 1.2%, as the H-share index declined 3% and China Evergrande lost another 10%. Now, according to analysts, Credit Suisse First Boston, Greater China, excluding Hong Kong, but including Macau and Taiwan exposure, is highest for DBS and OCBC at 14% and 13% of gross loans, while it is smaller for UOB at 5% of gross loans. And the research house maintains that while Singapore banks do not comment on specific exposures, none of the Singapore banks show up as principal bankers in the 2020 China Evergrande annual report. And that suggests that direct exposure is likely to be small, if any. Now, global growth really is driving our sectors across the world, and that means we've seen many mixed moves with the very, I guess, uneven recovery that we have still seen, and some little bit of weakness in the sequential numbers, not just locally but globally in recent months. Now, a key reason for the various indices and the sectors consolidating on their first half gains has been that clear signaling from the Fed Reserve that while tapering of asset purchases may begin before the end of this year, the consideration of the Delta variant and its impact on the US labor market does remain a priority ahead of interest rate hikes. And we'll get an update tonight when the Fed meeting concludes at 2 a.m. in the morning, Thursday. And I think the press conference is then after at 2:30 a.m. But as shown in this table, this is the 150 most traded stocks here in Singapore. The 3 banks, in addition to the 31 stocks that represent the REIT sector of these 150 stocks, they performed positive returns in both the first half of this year and the second half of the year going through to last week, along with 12 stocks representing the technology sector as well. And as a group, these 150 stocks, they make up 3/4 of our total market cap and 95% of the day-to-day turnover of all stocks on the exchange. For the first half of this year, we saw our economy in Singapore rebound 7.7% year on year, while the STI ranked among the 3 strongest Asian benchmarks, and all key sectors of the Singapore stock market, as seen in this table, were in the green. They were in the green, while a number of stocks also reported bumper year-on-year earnings growth. As seen in the table as well, the second half of this year has started on that more mixed note, which has been a global development. Concerns of the continued growth in COVID cases on decelerating economic growth has been in place, reinforced by pretty much 4 million new cases across the world of COVID-19 continuing every week since the end of June. And furthermore, that 7-day rolling average of the daily new global confirmed COVID-19 cases has still not spent meaningful time below 350,000 since October 2020. And that's despite global vaccine progress, which should see around 9 billion vaccines administered, 9 million vaccine doses administered globally by the end of the year. The concerns since the end of June have really seen, I guess, the global stocks, what we've seen globally is the big global benchmarks covering the whole world have generated a marginal decline over the past 11 to 12 weeks, while Asia Pacific stocks, including the SDI, have generated 2% declines. Now, since June, mining, utilities, technology, healthcare products, and basic materials have been among the stronger industries of the global stock market, while those segments such as lodging, food services, leisure, airlines, and transport have been among the lesser performing industries. And this has reflected that increased focus across the world, particularly over the past 11 to 12 weeks, on the companies or the industrial and trade segments of the market that have been able to, I guess, remain fully operational in the course of the COVID-19 constraints, while possibly also seeing increased demand for their products and services. As you can see in the table that represents the Singapore market, utilities, technology, among the most defensive sectors in the first part of this second half of the year, as of last week. Those industries within the consumer cyclical have been among the least performing segments. And the strength in manufacturing in Singapore in 2021 has also extended to the stock market, with manufacturing stocks in Singapore spanning multiple sectors, including industrials, technology, consumer staples, healthcare, material and resources. And in addition to the outperformance of the industrial and the manufacturing and trade focused stocks compared to consumer and tourism related stocks, you can see this, I guess, a glimpse of this, or a mirrored comparative to this within the REIT market. So the median gain of global industrial REITs was 5% since the end of June through to last week, compared to a median 2% decline for Asia retail REITs and a median decline of 5% across all global hospitality REITs. So in Singapore, the strongest performers of the industrial S-REIT market have noted that while the economic climate continues to be challenging, logistics continue to demonstrate resilience, particularly in ASEAN, with demand for industrial real estate underpinned by the manufacturing sector, which has been attributable to the expansion, of course, of electronics, precision engineering, and chemical sectors. I've got one slide more here, and I just wanted to show that among Singapore's 150 most traded stocks this year, there have been 22 stocks that have seen more than a 10-fold increase in daily turnover in the year to date. And this includes 11 stocks listed on the main the industrial sector, with I think as many as 6 stocks. 4 stocks represent the consumer cyclical sector, while the energy, basic materials sector and the real estate sector were each represented by 3 stocks. The real estate, excluding the REITs and sector, and the basic materials sector is obviously very relevant to our next presenters as well. I think Straits Trading across their real estate segment, I think the EBITDA was close to $170 million compared to $37 million for the first half of last year. And of course, that from resources as well, which I think had the EBITDA of around $16 million in the first half of this year, which was up from $500,000 for the same period last year. So I'll quickly round up now, so you can hear for the main event in the next 5 minutes or so. But I just did want to show you that within these 22 stocks, they did generate median total return around 100% in the first half of this year, but they also generated a median decline of 12% over the last 11 weeks. And that comparatively higher return over the past 36 weeks of the year, I guess, it also saw higher risk. Those 22 stocks generated 3-month historical volatility rates around 90%, which is comparatively high. Del Monte Pacific is the largest of the 22 stocks by market value. 2 weeks ago, it reported for its first quarter for FY22, so that's the quarter ending in July, and it reported year-on-year turnaround net profit of $18 million. The company also ended its FY21 on a stronger note, reporting, I think it was back on 23rd of June, that the FY21 turnaround net profit was $63 million, and that reversed an $81 million loss back for its FY20. The group's second largest and most profitable subsidiary, Del Monte Philippines, saw its international market sales for July ending quarter rise 40% year on year. And that was robust sales of packaged fruit and beverages. That includes its premium packaged pineapples in the United States and the S&W packaged products in Asia. Of the 11 listed catalyst stocks in the table, Grand Venture Technology maintains the highest market value. Back on 10th of August, the company reported a 280% year-on-year surge in its first half numbers, its first half profit, to 8.5 million Sing dollars, and it also declared its maiden dividend. The company has also recently completed a placement of new shares, and that's going to help fund the growth of its customer base and capacity scale of this company, which is a homegrown manufacturing solutions and services company. And furthermore, the company is undertaking a transfer listing from the Catalyst to main board, which it announced back on the 1st of September. For the best performer in the year to date, you can see it's OIO Holdings, which saw the greatest increase. Sorry, it wasn't the best performer. It was the best. It saw the highest increase in trading turnover in this year compared to last year. And that's why it's at the top of the table there, with average turnover this year of close to $1 million. And the core business units of this company are blockchain technology services and mechanical and engineering services. So just to sum up, these charts and tables, they are also available on all our content, research and education channels. And please feel free to reach out to us if you would like a copy of the slides or any more reports or details on anything that we've discussed further. So I will end the session here promptly. And I thank you very much for your time again, and very much looking forward to this next presentation. Thank you.
Thank you, Geoff, for sharing. And next, we are pleased to welcome to the representative of the Straits Trading Company Limited, Mr. Eric Tang, Chief Executive Officer, Dr. Alan Tan, Head Portfolio Management, Mr. James Kwee, Portfolio Manager, Portfolio Management, Ms. Selina Ho, Head of Investors Relations. They will share with us more about the company. Ladies and gentlemen, please.
Thank you, Eugene. Good afternoon, everyone. My name is Selina, and I'm the Head of Investors Relations. I would like to do a quick introduction for those of you who may not be as familiar of the leadership team that is at the helm of the Straits Trading Company. Our Executive Chairman of the Straits Trading Company is Ms. Chu Kek Kim. The CEOs of the business unit. So we have Mr. Eric Tang, CEO for Straits Developments Private Limited. We have Mr. Desmond Tang, who's the CEO for Straits Real Estate. Dr. Patrick Yong, who's the Group CEO and Executive Director of Malaysia Smelting Corporation. Mr. Manish Bhagava, who is the CEO of Straits Investment Management Private Limited. Ms. Tan Hui Yi, CEO for STC Property Management Sindra Bahar. Ms. Joyce Tan, who's the Group Financial Controller. And Ms. Goh Yahui, who is the Group Treasurer. Next, this is the management team at the various business units of Straits Trading Company, Straits Real Estate, as well as Malaysia Smelting Corporation. Next. Now, Straits Trading is a company that has a very long heritage and history, and it has undergone many transformations since the start of 1880s. And here I would be sharing with you the various transformations that the Straits Trading Company has gone through. In Straits 1.0 in the 1880s, it started out as the world's largest tin producer and was renowned for its finest grade of tin. And at this point in time, it is listed in the bourses since 1994 with tin resource business comprising of mining, smelting, and trading. And in the Straits 2.0 transformation, which took 30 years, we started to diversify into investment and property development with the colonial properties that were purchased way back in 1923. And some of the properties that we have developed included residential, commercial, as well as land banks in the heritage land that we owned previously. In Straits 3.0, we started to venture into hospitality in 1994, where we started to trade as Rendezvous Hospitality Group in Asia Pacific market. And we also owned and operated 13 hotels across the region. In the Straits 4.0 transformation, we started to look at our businesses and transform them into scalable assets and sustainable growth engines with the successful takeover of the Straits Trading in 2008 by the parent company. Currently, in the 2020s, where we are at the Straits 5.0 transformation, we are looking at converting assets into investment products and platforms for new growth engines. We have also launched our shareholders club to engage our shareholders actively and constructively. There are a few objectives. One is to help to broaden the investor space Secondly, it's also to enhance the knowledge of our shareholders in the Straits Trading's business. And also thirdly, we hope to have more opportunities to engage our shareholders and understand what are their views on the Straits Trading Company. Next. Here, I will be sharing with you some of the examples of how the Straits Trading Company has transformed its businesses into scalable assets. In the first instance, where Straits Trading divested its stake in WBL for 508 million in cash and recycled capital into ARA for 294 million, ARA's AUM has grown to 128 billion. And at this point in time, with the combined shares and cash valuation of the Straits Trading stake in the ESR-ARA merger, its total worth is 1.14 billion. In the second instance, where we sold the Straits Trading building for 450 million, we have recycled 358 million into Straits Real Estate. And today, SRE is a growing investor with over 2 billion in invested assets. In the third instance, where we realized the value of our hospitality assets in Straits Trading, which included 285 million in Rendezvous, Singapore, we entered into a joint venture with the Far East Orchard, taking a stake in the 30% and Far East Orchard taking. With this, we have transformed from a wholly owned portfolio of 3,000 rooms to a combined portfolio of 18,000 rooms. Next. And with this, I would like to hand over the session to Dr. Alan Tan to take us through the corporate structure.
Thank you, Selena. Okay, so very quickly on page 9, overview. Essentially, Straits Trading under its conglomerate umbrella, by and large, is a property-centric company, as shown, and also with a bit of exposure on the resources and hospitality side. Moving on to next page, you look at the numbers for the first half this year. Our EBITDA contribution primarily derived from Straits Real Estate, about close to 80%, close to 145 million, and followed by ARA, 23.7 million, about 13% of the total group EBITDA. These two jointly contribute about 9 shares of earnings and as well as asset base. Moving on, page 11. Some quick highlight of our key investment thesis. We are proud of having a well-diversified portfolio. This portfolio has been serving us very well, providing steady and recurring operational cash flow to weather through the pandemic. And even during the pandemic, continue to chug along and deliver sustainable earnings. The third one will be the highlight of the merger between ESR and ARA, which we will look into later on. And last but not least, Strategist, being the controlling shareholder, holds 70% stake in the company. Moving on, some quick highlight of our different engines, including real estate, hospitality, and resources. For instance, under real estate, we have a Straits City, which being a mixed development project in Penang, with a total estimate GDV at least ringgit 3 billion. And also, apart from SRE, we also have our SIM, being the Straits Investment Management, a in-house fund management vehicle investing into public listed equities. Moving on to next session, a quick flavor of our first half performance. As mentioned, we delivered a credible EBITDA for the first half this year. In fact, an all-time high, 187 million, primarily derived from core real estate as well as resources, while hospitality continued to suffer from a COVID impact. In the meanwhile, we also divested 2 good class bungalows, about valuation, proceeds of 65 million. Overall, we are comfortable with our financial flexibility, which position our well to seize additional opportunities during pandemic. Now, page 15, a quick highlight. Under Straits Real Estate, I think it's worth noting that the early part of this year, we acquired minority stake under Straits Real Estate for 105 million. The Straits Real Estate become a 100% owned subsidiary of Straits Trading. Now, ARA is, as mentioned, the merger will be the focus of discussion. Resources side, I think it's also worth mentioning that coinciding to the commodities upcycle, Tin particularly is a top performer in terms of prices. Year to date has been an all-time high. Now, the Malaysian subsidiary is clear beneficiary of the Tin price rally. Now, moving on to the next section, Straits Real Estate. In a nutshell, look at on page 17 from an investing asset base. Look at historical track record since Straits Real Estate incepted in back in 2014 with slightly less than 316 billion invested capital. Now, over the last 6-7 years, has been growing to 2 billion invested assets, and there's a clear near-term target of 3 billion invested asset in sight. Now, the story behind the growing of the invested base is a consistent and credible ROE track record. This showed on page 18. As you can see, about average ROE of last 5-6 years, about on average is 10%, and this is especially also being held consistent over the last 5.5 years even during COVID, underpinned by discipline and proactive divestment year on year. Now, moving on, page 19, quick flavor of the property footprint held under SRE investment portfolio, largely fall into 3 clusters. The first one will be the modern logistic portfolio. This one we're building and growing in both Australia and Korea. The second cluster refers to office properties in Japan, Australia, and UK by way of recent acquisition of a business park. The last will be retail malls in both China and Malaysia. Now, from another lens, on page 20, if you look at the asset composition by the nature, the key highlight would be that the 19% of the assets are income generating. And also, if you refer to the pie chart in the middle, you will see that the new economy classes being logistic and the business park now comprising about 60% of allocation of asset class and growing. Now, moving on, page 21, a quick color on the logistic assets now being positioned under SRE. SRE has been growing these logistic assets in both Australia and Korea, and been received very well. Each serve a distinct cluster of customers and deliver a fantastic return during COVID, and especially post-COVID, we see secular long-term growth trend, and we are committed to double down in this sector. Now, total portfolio across these 2 countries about 10 properties, slightly more than 500 billion. This represents close to 40% of the valuation uplift since December last year. Now, a bit of outlook going forward. SRE is firmly committed to continue to develop capital into logistic and office business park segment. In terms of geography, we will stay within our comfort zone, being in Australia, Korea, Japan, and a bit of the UK as well. Okay, so this concludes the first section under our business property industry. I will hand over to my colleague. Okay, thank you, Jim.
Okay, yeah, thank you, Dr. Alan. Right, so let us move on to Straits Investment Management. It is a registered funds management company and it invests in income-producing securities. It generates fee income, right, for the company other than the investment returns, and it's generating quite a good return for us up until this point. So Straits Investment Management is also an advisor to the Nikko Straits Trading ETF, and it has 2 actively managed funds, which is the Straits Global Property and separate managed accounts. So moving on to ARA, right? Since ARA's privatization in 2017, it has transformed itself into a leading APAC real estate, 28 billion in assets under management. Sort of global presence with a focus in APAC and a broad range of products, from REITs, private funds to the new economy sector assets like the logistics and data centers. So just to highlight that the Logos merger was recognized as the deal of the year, and that transformed ARA into a vehicle in all these aspects of a new economy asset life cycle. It covers all these. And then the merger with Venn Capital over here also broadens the scope to private debt, right? And ARA receives also many accolades and shows that they are very much focused on the ESG space as well. Okay, so moving on to next slide. In March, ARA successfully privatized Financesg with Sumitomo Mitsui Finance, and it increased its stake to 30%. And then in May, Sumitomo Mitsui Banking Corporation came in as a strategic investor, participated in 500 million equity fundraising round. And SMBC is a world premier financial institution with about $2.25 trillion in assets. So the highlight for us is on 4th August, ARA and ESR signed a merger agreement, and the merger will combine to create APAC's largest real estate manager and the third largest listed real estate manager with a lot of exposure to the new economy real estate, which is growing very quickly. Right, so this also is a realization of Ms. Chu's vision, our chairman's vision of creating a Blackstone of Asia. So the proposed merger, right, when completed, will deliver total consideration of $1.1 billion, as you heard from Selena earlier, comprising $135 million in cash and about $1 billion in securities. This is about $700 million higher than our carrying value of $430 million. And assuming the transaction is completed, our company's NAV would have increased from $4.03 to $5.78. That's an increase of $1.75. Right? And just to highlight a little point over here is that based on the latest announcement, the company, ESR itself, the company has obtained more than 50% of the shareholders' undertaking, irrevocable undertaking. So the deal is more or less considered done, subject to the EGM to be carried out. Yeah. Moving on to the hospitality, right? This slide 31 tells the story, right? Far East has had a portfolio of 13 properties, with less than 3,000 keys back in 2013. But we have transformed our company into a top 100 international hospitality owner and operator with 105 hotels and 18,000 rooms, right? And then in the process, we have also received $270 and $68 billion in Far East hospitality trust units, which we have sold, right? So what happened in Far East hospitality for the first half of the year? It opened 4 hotels with about 1,000 keys, and the photo on the right shows the 300-key planned hotel at Cross Street. You might have seen the hotel. So overall, we expect the hospitality segment to continue to face headwinds with all these lockdowns. But we remain optimistic in the longer term as the rates of vaccination increase. As you can see from the news as well, there's green lanes, there's open travel corridors, so all these will benefit hospitality. Right? Company has also this entity also has a strong balance sheet, so that helps. Okay, moving on to the property portfolio. Straits Trading is working to unlock the value of a very beautiful piece of land at Butterworth, Penang. The total acreage 40 acres. Right, and it's going to be an integrated development, as you heard from Selena earlier. It has a GDV of about 3 billion ringgit, right? And it's very nice view of the Penang Island for those who are familiar with Penang. Moving on, it's a very prime location located next to Penang Central, which is an integrated transport hub. And then there are a lot of amenities around there, including the newly gazetted free trade zone, right? So the phase 1 of the development is a 4-star hotel, scheduled to be completed 4Q 2022, and it's close to industrial parks, so very well positioned to meet business travel demands when the traveling resumes. Okay, moving on to our resource segment on slide 38. our 52% owned Malaysia Smelting Corp continues to enhance sustainability and competitiveness with initiatives to raise productivity at both the mines as well as the smelter. As highlighted by Alan earlier, the company continues to be profitable because of very high tin price and then very strong demand from the electronic sector as well. So the Pulau Indah smelter over here is on track to be fully commissioned, and when completed, right, it will definitely improve production yield and has a much smaller carbon footprint. Okay, so what's exciting about tin, right? So according to this research, right, this is the metal that is most positively impacted by new technologies like electric vehicles, advanced robotics, and renewables. So all these areas are seeing double-digit growth. Okay, we've come to the end of the business section. So with that, maybe I'll just end here and take questions from the floor. Thank you.
Thank you, Mr. Eric, Dr. Alan, Mr. James, and Ms. Selina. We will proceed to the Q&A session. You may post your question in the comment section below, and due to time constraints, we will endeavor to answer them. Can I have the moderator, Mr. Benjamin Goh, Head of Research, SIAS, along with the representative of the Straits Trading Company Limited to kickstart this session.
Thank you very much, Eugene. So first off, thank you very much for joining us, the senior management team of Straits Trading. Very appreciative whenever senior managers from a company speak to our shareholders as well as members of the public. An admin matter is that we do have a hard stop at 1:30. So for members of the public and people who are tuning in, if you do have a question, I would strongly suggest that you ask it. Because we definitely have to stop at 1:30. We have a different event after that. So may I just kick off with the first question then, just to give some time to our friends to gather their thoughts. We've heard that in Straits 5.0 plan, real estate is going to be the main focus for Straits Trading. And to be quite honest, Straits Trading is one of those very interesting companies where there are quite a few different distinct platforms. You have got the Straits Real Estate, you've got the Straits Investment Management, the STC Property Management, as well as direct interest in the ARA REIT, as well as the Centec REIT. So the question that I have is, would you be able to explain the rationales for having all these different business units or distinct platforms? Are they really that different in terms of strategy, risk reward profiles, so on and so forth?
Well, the quick answer, Ben, is that in the context of a conglomerate investment company, by default, we'll look at diversification. So using the property as an example that you just raised, of course, the property is one of the three businesses that we have. Clearly, we diversify within the property asset class. We love to call it an ecosystem. Actually, we're about an ecosystem. We cover almost everything except owning a property sales agency. Beyond that, I think we work with contractors or agencies in the market. The key example of a risk reward is at any point in time, Ben, and even for my fellow shareholders here, it's at which point in time where the market opportunity resonate with you. So far, from our own experience for the longest of time, clearly they are in various markets. Like for example, in the private space, there are deals to be made. This is where SRE works in the private equity space. Whereas in the public space, where you have the REITs and the public markets, we have SIM, which is a fund that do it. If we're looking at the traditional model that Singaporean developers love to do, is development, right? The greenfield, the brownfield, or that you name it. We have done that before in the past, but in the Singapore context, we're a little bit hesitant. I think with all the government rules and restrictions on real estate development for residential, we're better off looking at other opportunities. So we look at other opportunities as we have presented to you in the logistics space in Australia and in Korea, and for that matter, in upfront our neighbor in Penang. Yeah, and by doing that, by being diversified, clearly we have survived many crises. 10 years ago, when we had the global financial crisis, we did well. And even recently in the pandemic, the hotel is down. We're losing money in the hotel. There's no doubt about it. But we're doing well in the rest. So on the whole, we're still okay, if not even better. Thank you. I hope that answers the question.
Yeah, I think that's great. So that's kind of explains the whole business model in terms of diversification. And obviously, we keep telling our SIAS members and members of the public that they always need to diversify. So in terms of that, I think Straits Trading is obviously very well positioned because you have got one counter or one company that already has got a lot of risk management and diversification embedded. So I think that's great. All right. The next question that I have is, so alongside the diversification across different, business units or platforms, how does the management plan to allocate its capital or its cash flows for the different needs, competing needs of dividend payouts, interest payments, as well as CapEx, capital expenditure? And does Straits Trading intend to have a formal dividend policy or target capital structure?
Okay, so well, the second part of the question, dividend, that is the most asked question. But let's talk about how to make money first before we talk about the dividends. So
My favorite topic, yes.
First, the first part, yes, truly everyone's favorite topic. But the first part clearly is how do we make the money first before we worry about the dividends. In reaffirming what I said earlier about a conglomerate investment company, all the various entities that we have within the group, quite honestly, everyone is doing well and everyone who demands is pound of flesh that we all could look at opportunity in many spaces that we're looking at. So then at the board, at the group level, clearly we allocate according to the risk reward. Like for example, just to give you a simple example, asset management, okay, the latest hot topic is ARA ESR. Like what James had mentioned earlier, we had invested $294 million, okay, that was back in 2013. Given the current fulfillment, I use the word fulfillment, I don't say exit, it's about 1.14 billion. So clearly 3 times the number, okay? Do we then stay invested? Obviously we should, because this is like resonate with our model of scaling up. So we may be big in that context, but today by merging with ESR, become the largest listed asset manager in Asia Pacific and the 3rd largest in the world. So clearly there's opportunity there, right? Then using that example alone, okay, in the interest of time, then from a so-called dividends point of view, people have criticized us that we are quite how should I say, quite stingy in giving dividends. So if you look at the dividends chart that we had shared earlier, we have been very, I wouldn't say stingy, I would say very consistently sustainable. Okay, so we have gone from 2 cents, 4 cents, 6 cents. So naturally, we hope the trajectory will go up, but that will obviously depend on how well we do, rather than we borrow money to pay dividends, which should be based on those results that I mentioned earlier. But the good news is that if there are special, what do you call that, special dividends, or rather fulfillment of certain projects, like for example, ARA and ESR, lots of people have asked, so what's the kicker now? But honest answer is you never count your chicken before the hatch. So eventually, like what James said earlier, the deal is done. We have the formality of the EGM, I think sometime in October or November. And then we're through with that, and then we will then look at incentivizing and fulfilling that part of what we've always been given. Historically proven, if you look at the chart that we just flashed across to you, since 2008, I think we're given about $4 plus, almost $5 worth of special dividends. And I think that will speak for itself. So I would just urge our shareholders to be patient, and that while we also embark on the new growth story, as evidence in what we're doing in 5.0, hopefully there's more in it for everyone. Thank you, Eugene.
Okay. Well, Straits Trading strikes me as a company in a hurry, hungry and firing on all cylinders. And I think that is probably the what you call the perception that investors should have. That is, less of a sit back and wait for the money roll in, but more of a growth story. So, within that lens, then obviously cash flows may not be paid out as dividends, going to be reinvested into the company. So I think that's, understandable. All right. So thanks for that. The last question is obviously a question which is on everybody's mind. Again, ESG. ESG has been around for decades, but is a very big theme nowadays, not just in the West, but also in Asia. So with respect to ESG, would the management be able to provide some color on its sustainability efforts and its ESG plans going forward?
Well, to be fair, ESG on its own, as you rightly mentioned, is something that all our so-called subsidiaries are very responsible for, way beyond and way before the emphasis in the last couple of years on ESG. So while the proof is in the pudding in terms of what we will do tomorrow, but a quick recap of what we've done in the past, even way before ESG came about, will be something which I just want to quickly share with you, just to reaffirm that if we have done that in the past, how on the ball we are and looking at ESG in the future, will be the mining/resources business. So that would be a classic example, just to share 2 or 3 things with you. As you know, resources is always something that people will say is obviously an environmental issue. Okay, that one is a given. Absolutely no doubt about it. Okay, so to do that change, a few things we did, primarily in terms of our smelting business. Last 3 or 4 years, we have actually completed the setting up of a smelting plant in Klang in Selangor. This is an old reused battery-led plant. It was all remodeled, re-engineered. It's a fantastic piece of work. Right now, it's really firing up. And once we reached its critical mass, it's so-called output production. We should be able to then close down the one that was used in Butterworth. Of course, there's a bit of delay, no thanks to the MCO in Malaysia that hindered the operation of the smelting part of the business. But notwithstanding that, that's being done. So when that is done, obviously that piece of so-called the smelting that we had for about almost 100 years, will obviously have to be decommissioned. Okay, that's another piece of environment or ESG work to be done. And the neighborhood or the Penang Knights could have seen that being transformed, so they could see that we are putting, how should I say, putting money where, I mean, we mean what we say lah, and we do what we mean. So when we do that, we will unlock the land to then be part of the development plan that James mentioned earlier about the Straits City. So just that example alone is just to give you a bit of color, how we could then constructively do the ESG at the same time benefit the company. And of course, there are many other things we do. To give you one last example, a lot of interim tenants were occupying some of the land bank. Rather than have all these risking security, risking people, we actually shut down all the tenants, rather level up and not collect any rent, just to make sure that things are proper and clean up. As you know, if you have squatters lying around, there could be crime, there could be other social issues. So we are a very responsible citizen. So just a tons of examples I could give you. But I just want you to know that moving forward, we clearly will support SGX initiatives in the ESG space. Yeah, thank you.
That's certainly very interesting, not just for Singapore investors, but international as well as institutional investors tend to view ESG as a filter, as in if a company doesn't fit a certain ESG profile, they wouldn't even consider investing in it. So I think it's very good news, fortunate that Straits Trading is moving into that front, because obviously as a Singaporean, I would like to see Straits Trading meet higher highs. So that is like one checkbox ticked, so it's all great. Let me do a quick check with the SIAS team. Do we have any questions from members of the public? So ladies and gentlemen, we have about 5 minutes left. If you do have a question for the SIAS senior management, you need to let us know quickly so that we can have them answer it before our time is up. Maybe I can conclude the discussion with one question. So with regards to the investment portfolio, you have got the Straits Investment Management as well as the Straits Real Estate business units. Is there a certain particular or specific profile that you look for in terms of an investment target? Any particular strategy when you decide on what to invest and when?
I would say that the strategy is one that is anchored in the idea of asset allocation and how we do risk risk reward adjustment. The target in terms of qualitatively speaking, we mentioned about ESG, so that's important. We also look at targets where we are in countries that we are familiar. No point going to region, countries, cities that you're not familiar with. So this could be where we have anchored partners, people who know the ground, that we ourselves know the ground as well. So these are example. And also in terms of scalability, how we could scale up. This will be the example or the target. Last but not least, I think you'll be interested to know the financial return. The financial return, as in the first half, looks quite okay, but this is just the first half of the story. Generally, I think we look more at the our IRR of about, say, 9 to 10%. I think that's something which all my colleagues will look at driving ourselves. And that will be a quick answer to Ben's question. Yeah.
Thank you very much for that. That's quite a good number, 9 to 10%. Okay, we now, as usual, Singaporeans, better late than never. Now we have a flood of questions coming in. So hold on to your horses. All right, so the first one, will Straits Trading maintain its stake in ARA Holding after the merger, or do you intend to liquidate?
In the foreseeable future, we will be maintaining it. I use the word foreseeable future because, as I said much earlier, we look at all the opportunities over a wide spectrum. At which point do we think another area requires a better use of the capital? We will look at it. And quite frankly, as a responsible listed company, we're expected to always keep our options open. You cannot be closed by that and say, nope, this one die won't sell. This one, die must buy. It won't be the kind of things. Yeah. So I think in that regard, I just want to assure you that it has been proven, like as I said, 2013 to now, and how the journey continues, as of now. Yeah.
Okay. Next question. What is the synergy among the various business units? I think this harks back to our discussion on the distinct platforms. Would you be able to give an example?
When we say synergy, we could look at how we help each other and work together. So let's say, for example, if we take return in a longer, like a PE model that SRE is doing, we usually before pandemic was about 3 to 5 years. With the pandemic, I think we've got to be a little bit more conservative. So let's say at least 5, maybe even 7 years. Okay, so there's also synergy where some of the capital, if there are surpluses, they are not, staying idle. I don't think anybody want to keep idle cash around, let alone a company. Then we could stay invested in, let's say, in the capital markets or in the money markets through SIM. So SIM itself is a good platform where we just park the money there. You give us an absolute return because we're doing our own, our own trading, our own investment. Yeah. And that's how I would explain that in terms of synergy. And guess what? There's no better synergy than synergizing with the shareholder. At the end of the day, the shareholder sees their synergy as just taking dividends from the mothership, which is Straits Trading. That's fine and good. But for big shareholders, we also allow them to work closely with us on the project basis, right? Even for smaller shareholders, as we have recently launched, as Selina had alluded earlier, about the Straits Trading Shareholders Club, we actually give them the opportunity, especially for those who are accredited investors, to co-invest with us. Literally co-invest with us. What we do, you can invest with us at the same time. Yeah. So in that way, it's synergy all the way. So that means the relationship with the company isn't just so cut and dry, looking at the dividends. And that's a good thing because I think most shareholders we've spoken to like the idea. I think most shareholders also like to invest in fixed income, in bonds, because just dividends alone is just one part of the story. Yeah. So that's synergy for you, Ben.
Yeah, dividends itself could be a bit boring. Actually, it's quite interesting. I didn't know that you did allow accredited investors to co-invest.
Yeah.
I've never heard that for any other company.
Yeah.
But I think that again, points to the fact that Straits Trading is different. It's a company on the move. Okay, I got a couple of questions. I think I'll just have to pick one for the last one. Okay, so this one, okay, as a conglomerate, the share price usually trades at a significant discount. So I think this viewer is talking about the conglomerate discount. Right, so too many things in one company. So would it be better for the management to spin off the individual business units once they are of considerable size?
Yeah, I think there's always a possibility, potential, which most shareholders have asked. Some of them be more direct when they ask the most direct question, hey, why don't you privatize? You know, blah, blah, blah.
Yeah.
So there are many ways to skin the cat to how to return a bigger piece of the pie. We all know that the sum of the parts make one set of the story. If you break it up, it becomes a different value. But I think the strength of Straits Trading, as it has been for the last 134 years, next year we celebrate an important milestone in our journey. It's 135 years. Clearly, we're an old dog, no doubt about it. One of the oldest dogs in Singapore. But clearly, what you have seen so far in this presentation, we've got a lot of new tricks as well. Okay, so I think by and by, it's important that we continue to see ourselves growing. Hopefully, shareholders appreciate what we are doing, and that inevitably narrow the gap. There's no hard and fast rule about the what do you call it, narrowing the gap, which some investor feels that a conglomerate should deserve a discount. Then the question is, what kind of discount? Okay, and what percentage of the discount? As we speak, we are about NAV about $4.03. Okay, and if we successfully conclude the pricing and the ESR deal, the NAV could go up to as high as $5.78. Okay. So we are well below what we are now, and much lower what we were the other day or last year. So it's anybody's guess, quite frankly. But we really believe that if we lock in our horns and we work on that, hopefully the growth story, as I said earlier, is important. That shareholders get to know and understand what we are doing. And to be honest, this is the first time we're participating, so I'm very pleased that SGX and SIAS has got us involved in this. And so hopefully you understood a bit more about us.
Well, thank you very much for your time. I would say that I think Straits Trading is one of those very interesting companies which tend to be overlooked, you know, because we always talk about 3 big banks and so on and so forth. And of course, you've got Singtel and the telcos. It has been a very valuable experience as well as forum for our members as well as members of the public. So we're very grateful for the time that you've put in. For all our viewers out there, unfortunately, we have a hard stop at 1:33, which I've overran for 3 minutes already. So we definitely have to go. So again, thank you very much for the participation of the senior management of Straits Trading. Eugene, I'm going to turn over to you in case you've got any closing remarks that you need to make.
Thanks, Ben and fellow panelists, for being with us this afternoon. We have come to the end of today's webinar. It has been a pleasure to have you with us today. In case you missed any part of today's session, you can rewatch the webinar on SIAS Facebook page. Do like our page and check out our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a great day ahead.
Thank you.
Thank you very much. Thank you very much.
Thank you for spending the lunch hour with us. Thank you. Have a good day ahead. Bye.
Thank you.